Bloomberg Audio Studios. Podcasts, radio, news. This is Bloomberg Businessweek with Carol Massar and Tim Stenovec on Bloomberg Radio.
Researchers from McKinsey recently determined that women spend less time on the job than men in comparable roles and career paths. 8.6 years for women versus 10 years for men, and that they were more likely to make decisions putting them in roles and industries that were dying.
Gosh, that's kind of...
It's really grim.
Yeah.
Large career gaps, especially during child-rearing years, and the desire for more flexible work took a toll. Listen to this, Carol. Such time and career choices, they said, docked women's lifetime pay by a cool $500,000.
That's a lot.
Women, they urged, need to choose careers in fast-growing fields and spend more time on the job.
Wow, that's a strong message.
Yeah.
I mean, that's a big difference. And if you think about people living longer and like maybe on their own, like how do you support yourself?
Simone Foxman writing about this for Bloomberg News. Check out that story and more if you're interested.
All right, curious what Alison Kosik has to say about all of this. She's the author and journalist who has worked at CNN and is a freelance correspondent for ABC News. Equal pay is just one of the things she tackles in her deeply personal new book. It's entitled What's Up with Women and Money? How to Do All the Financial Stuff You've Been Avoiding. She joins us from Long Island. You know, we've been talking about your book and, you know, very deeply personal, your story. You go there right in the beginning of the book. Tell us about and share with our audience why you set about writing this.
Yeah, great to be on your show. Thanks for having me. So I wrote this because, yes, I was CNN's business correspondent, often reporting from the New York Stock Exchange. But at the beginning of my time there, I wasn't involved in my own financial life. I let my husband handle all things financial. And that was not a good decision because when the marriage went bad, when you know, I wanted to get out of the marriage, I felt stuck. I stayed in the marriage longer than I should have, years longer than I should have, because he kind of knew where all the money was and how to handle all the money things. And I had 2 kids under the age of 10 at the time. You know, what if I made a mistake? What if I lost all of our money? The difference is that I just didn't have the confidence to make those big financial decisions. I didn't have the experience of making the decisions over the course of my marriage. And that, in essence, cut down on my confidence in my ability to make those decisions. But as I got through that, I realized that there are a lot of women in different kinds of jobs, high income scale to low income scale, married, divorced, widowed, single, who feel the way I felt, that, you know, they don't have any kind of involvement or as much involvement as they should have in their own financial lives. And it's not something that women talk about because, you know, we don't want to be seen as unintelligent. There's also a lot of embarrassment and shame around it as well.
Why do you think men are the ones who end up doing this stuff in a lot of relationships? Like, you have a chapter in here on how to buy a car with confidence, understanding insurance, negotiating, in your words, like a man. Why are men the ones who usually do this in relationships?
You know, I think if I could answer that in one reason only, I think there are many reasons, but I think the biggest reason is that it is cultural. There's a cultural aspect that women have with money, and I think it starts early when we are girls. And whether we like it or not, girls and boys are socialized differently. And it's not that girls are told not to care about money. It's just that boys are often introduced to the family finances earlier. They're encouraged to be financially independent earlier. And so you've got these girls who grow up being uninvolved, and they can grow up to be women who avoid money issues. And that avoidance can be compounding in the way that you avoid something long enough, you become fearful of it. And so lack of interest can lead to a lack of information, and that lack of information can lead to a lack of confidence in being able to manage all things financial, you know, whether it's managing your spending, managing your debt, being able to invest, and being able to negotiate your salary. All of that hits confidence. And I think if I'm going to answer it in one answer only, I'd say it's the culture. It's got to be the culture.
So, you know, it's interesting. Carol mentioned this is a deeply personal book, and I mean, it really is. You don't just talk about your relationship and your marriage that prompted you to write this, but also your upbringing and your relationship with your father. And I think a lot of people would say that was really challenging. I'm wondering, though, as a parent now, how you make sure that your kids are equipped to make these decisions independently.
Very good question. I'm not a perfect parent, and I've got two kids. One's 19. My son is 19. My daughter is 22. They are invested in the market. Yes, I've taught them how to do it, and I've encouraged them to consistently invest as much as they can. I've explained to them the difference between savings and investments, and what the difference is, and why it's important to invest your way to wealth, because you can't save your way to wealth. Um, but the thing is, these things are not taught in school. So there's only so much parents can do. And really, I think so much of this is really just taking the effort to learn it on your own, or through osmosis, or hopefully you've got parents to guide you. I'm certainly trying to guide my kids as much as possible.
It's interesting, Alison. We talk about this a lot here, and I feel like you've obviously, you're a journalist, and I know this topic has come up over the years. And I would say, for those of us who've been doing it for a while, just like yourself, I feel like I could go back 10 years and have this conversation. 20 years, I could have this conversation. I think about CEOs, female CEOs who've come in and talked about even that in their households to some extent. So I'm wondering, why haven't we? We've talked about financial literacy forever. Why isn't that happening? What is it that we are missing? Because you can teach stuff at home, right? But I wonder if we made it part of our curriculum from kind of a younger age, teaching kids about money, the importance of money, and all that good stuff, how different things might be.
Oh, I am 100% with you. And to be honest with you, I don't know why this stuff isn't really being taught. And I think it's actually beginning to be taught. It's being thrown into the curriculum. I don't know how much really, and I'm wondering if maturity has a lot to do with it, because can you imagine getting into all the finer details of investing with a 15, 16-year-old? I think there's also maybe a mindset here of younger people. I know when I was younger, and it may have just been because we didn't have access to investment platforms like we do today,
Right.
even fractional investing. I think that you think that you have got, at 15 years old, let's say they bring it into the schools at 15, the curriculum at 15 years old, you pay attention, but I guess how seriously will the kid take it? Because they think they've got forever to start investing. And I think unless the curriculum really hits home about the importance of investing early and consistently, but investing early, maybe then it'll catch on. But I think you make a really good point. And I did write this book through a journalist lens. So not only did I get the tips and tools of financial literacy, I wanted to tell stories. So not just inspirational ones through the celebrities that I interviewed, but also names you wouldn't recognize. A lot of these people, a lot of these women are anonymous because they are ashamed that they're in this situation. So for example, I interviewed a venture capitalist who described money as something that she was fearful of. And she, at 53 years old, she hadn't invested in one retirement account, didn't know the basics of personal financing, and really felt overwhelmed. And this is a woman in the venture capital space, who was highly, highly successful, but she had not invested in herself because she didn't have the confidence. I mean, it is really amazing that we can be badasses at our jobs, but then in our own life, there's this disconnect that's really inexplicable.
Yeah. And I guess what I would say in terms of, I agree with you, like a teenager, they're going to be like, investing, Warren Buffett, like all that stuff might go past. But just the idea of debt versus not debt, savings versus, just kind of those kinds of things. Or like, you even talk, I love this idea. I think I even remember my parents having an envelope in the drawer of cash that was like the cash for the month or something. And we don't really do that anymore, right? Everything's digital, but having that concept of like a digital envelope of this money is my spending money, this is my savings money, like those concepts are really clean and pure, and I think make a lot of sense. And I do think about even today of giving a kid and saying, here's some spending money, that's it. You've got it for the month, figure it out. Like that's teaching them to budget.
Right. And getting them involved. And as parents, your kids are watching you. They're watching if you're piling on debt onto your credit cards. They're watching, how you shop around for things. If the refrigerator is broken, do you just buy whatever, or are you taking them with you to go shop around and get or at least online to shop around and get the cheapest price. I think involving children in money details is really a first step. It seems so simplistic, but it really
Yeah.
is a way to get them involved early.
Okay. We have been talking about your book in the newsroom and you coming
Oh, I'm
on.
so
And I have a
glad.
bunch of questions actually from one of my producers. We only have time for one. We only have about a minute left here. But if you've got two 401k plans from different employers, how do you determine whether to merge it or just leave it alone?
I've been told to merge them, but you're asking the wrong person. I'm not a certified financial planner. I can't even give you financial advice.
Okay.
That is not my realm. So like I said, I approached this book as a journalist. I did research and interviews to get these topics on paper. And they'll have to go talk to their CFP.
All right, that's fair. Actually,
That's good advice, though.
Actually, that's great advice. And she's a journalist too, and I know she'll end up doing research. 30 seconds left here. There's a lot in the book. It's very usable. It's really fun. What's one piece of advice you want to leave our audience with, just quickly?
Ladies, be involved in all things financial in your house. Have great visibility onto what's happening. Know what your assets are. Know your debt. Know who your beneficiaries are on your accounts. Know the passwords to your accounts, and especially know how much debt you are carrying. And get involved in the tax process as well. It's so as we're nearing tax time here, be involved in filing your taxes.
All right. Really fun. Good luck with everything. Alison Kosik joining us. Her new book, What's Up with Women and Money, How to Do All the Financial Stuff You've Been Avoiding, joining us from Long Island.
I want to see what Brooke May has to say about this because she's managing partner at Evans May Wealth. They've got about $1.3 billion in assets under management. She joins us this afternoon from Indiana. Brooke, you argue that the conversation has really shifted from inflation, kind of done with that. Now we're thinking about tariffs. But what is the conversation around tariffs?
To your earlier point, it's uncertainty. Right now, our concern is that the uncertainty will lead to an economic slowdown more than actually the facts at hand. When you look at CEOs recently that were surveyed, the survey took place late January, early February. They indicated that they're optimistic, more optimistic than they've been in recent quarters. That said, their biggest concern is geopolitical instability. And that's tariffs, in addition to a few other policies. So the sooner there's clarity there, the more likely they are to hire and to spend and and for there to be additional business investment.
So it is interesting when you think about kind of the environment that's out there, top of mind for you, because I think the headlines are fast and furious. They can change on an hourly basis. They can certainly change on a daily basis. They can change on a weekly basis. But is there kind of a longer term thought that you have about the environment we are, certainly from an investment perspective? And that could even be one that we don't want to do anything until it settles down.
Yeah. We're setting the expectation with our clients that they can expect volatility in the near term. Until there's more clarity, we're going to see a lot of ups and downs in the market. That said, right now the unemployment rate is 4.1%. We've got a pretty healthy labor market. Even though we only added 150,000 jobs in the last read, we still have more job openings than we do unemployed. So the labor market's what's held up this economy the last few years. And even though sentiment has shifted, that's not necessarily a good indicator for future market performance. We've got a $6,500 or 6,500 price target on the S&P between now and year end, which would be about a 14% bump. And again, once we have some more certainty, I think the market can move higher.
So Brooke, I'm wondering about something that Alex, it was Scarlett who just said this on our simulcast.
Said what?
It's this idea that tariffs are like, yes, maybe we'll get some clarity next week, but the president has shown that he can change his mind when it comes to this stuff, especially, if he has an off ramp with tariffs. If government of Mexico or the government of Canada, for example, proves that it's taking action at the border to prevent what he argues is a porous border and fentanyl being allowed into the U.S. Or maybe other parts of negotiation. So even if we do get some clarity on April 2nd, there's still going to be this uncertainty about whether he can just take back whatever he said on April 2nd in the coming days, no?
Absolutely. And I think that we're going to see that for the next 4 years.
So get used to it,
to be expected.
in other words.
Well, wait a minute. So
there's not much we can do about that.
Wait a minute, because I think there's an expectation that things are going to settle down.
Yeah.
So are you saying that it's going to be 4 years of volatility?
Not necessarily. I do think, though, we need to accept the fact that there could be pivots at any time. Right now, we've got a broad range of initiatives that they're trying to tackle. And while we'll probably see pivots for 4 years, I think that there'll be less as time goes on. The next few months, I know they've got a very robust agenda that they're trying to push through. And I think a lot of this is to set themselves up for an extension of the 2017 tax cuts and possibly even a lower corporate tax rate. So once they've been able to demonstrate that there might be tariff revenue or other income streams, then I think that we'll still see some pivots, but they might not be as frequent.
Do you think the tax cuts are priced in fully right now? Like, is that the expectation the market has?
I think an extension of the 2017 tax cuts are priced in. However, I don't know that we fully priced in a corporate tax rate that would be lower than what it is today. And as we know, that would be pretty accretive to earnings. So I think that there is some upside if we actually see tax cuts, a corporate tax rate cut. If
we actually see a corporate tax rate cut. Are you optimistic? Are you pessimistic? Where do you fall on this? There's not a huge majority when it comes to Republicans in Congress.
Yeah. I think that it's pretty imminent that the 2017 tax cut extension will go through. I think it's going to be a little bit more difficult to push through a corporate tax cut. I think that they're going to have to demonstrate that we're going to have tariff revenue or other cutbacks to actually be able to push it through.
Is all of this going to create, bottom line, an economy in the United States that continues to grow and that maybe outperforms other developed markets?
A corporate tax rate could. The other initiatives, if we possibly see less regulation, that could be a tailwind for some companies. But reality is, U.S. businesses figure out how to make money in all types of environments. And if we've got a strong labor market, people are going to spend, and ultimately the economy is going to stay afloat.
Do companies have figured out ways to pay a lower effective tax rate? So is it really that big of a deal if the corporate tax rate is lowered because companies have done such a good job of figuring out how to pay less in taxes?
Some have, and some don't. Some haven't been as effective. So there are companies that would benefit. I know that a lot of the big tech companies have been in the headlines for the low amount of tax they pay, but that's not true across the board. So there would be some companies that benefit and therefore make it accretive to earnings.
Hey, Brooke, one of the things that our Alex Steele just stressed, and rightfully so, in our simulcast chat on the close, the the S&P 500 equal weighted index was just down about 0.2% today, compared with about 1.1% drop in the S&P 500. So it was a lot of those big cap tech names that really dragged down the S&P 500. That equal weight, just a little bit lower, that difference says what to you?
It's exciting to see broadening in the market. The last 2 years, big tech, specifically, the Mag 7 has really been where the performance has come from. We saw somewhat of a shift from 2023 to 2024, and now we're seeing even a greater broadening today. And that's what we want. That said, we think that there's some opportunity right now in big tech, but not all Mag 7 companies are created equally. Today, we had some negative news out of NVIDIA, but systemically, the company, not much has changed. They're trading at 26 times forward earnings. And when you look at their growth rate, it's actually less than their PE, or it's higher than their PE ratio, which is the type of company you want to be invested in. However, you look at Tesla, and it's trading at 100 times forward earnings, and the growth rate is really paltry relative to the PE. We're seeing slowing sales in China and Europe, and probably some slowing sales here in the US. So I don't think you can go in and just buy big tech. In this environment, you have to be selective, but there are some opportunities out there, in addition to looking at the broad market or equal weighted.
All right, we're going to have to leave it there, but we appreciate you taking the time this afternoon. Brooke May, managing partner at Evans May Wealth, joining us from Indiana, $1.3 billion in assets under management. Carol, I found the Institute on Taxation and Economic Policy, nonpartisan institute. They found that America's largest consistently profitable corporations saw their effective tax rates fall from an average of 22% to an average of 12.8% after that Trump tax law went into effect in 2018.
I'd like a 12% tax rate.
So how much lower can it go?
For me or for them?
For them.
This is Bloomberg.
Okay, you might remember we recently talked about this Bloomberg story. It was about Air France unveiling a redesigned first-class cabin dubbed La Première,
Very nice.
seeking to attract well-heeled customers with travel experience that it says is actually kind of similar to stepping into a private jet.
We'll see what our next guest has to say. The new cabins, I just want to lay it out for everybody. Just remind you, each of the 4 enclosed suites feature 3.5 square meters of private space with a seat and a chaise that converts into full-length bed. The cabin took about 3 years to develop. It's about a quarter more spacious than the previous iteration.
I think it's $10K round trip.
10K, yeah, not
I think,
inexpensive.
but not private jet level.
All right.
Very, very far from private jet.
So let's see what Andrew Collins has to say. He's president and CEO of Sentient Jet, back here in our Bloomberg Interactive Broker studio. Good to have you here. It feels like everybody's chasing what you guys are doing. How are you?
I'm great, and it's great to be back. Thanks.
It's nice to have you here. My understanding, we got to talk to you as we were kind of busy, frantically working ahead of talking to you. You've been busy too. Tell us what your world is like right now.
I'm on the road a lot. Private aviation, as you remember, had the boon in COVID,
Right.
and it really hasn't slowed down. And so for Sentient, we're seeing about 15% year-over-year growth right now, and the forward bookings are actually encouraging. So, I know there's kind of a lot of pausing in the markets right now, and people scratching their head a little bit. But
Right.
from a travel perspective, I'm really not seeing a lot of leakage.
Why do you have to travel so much?
So we have offices all over the world. So we have a headquarters in Cleveland, Ohio, in Boston, here in the city, and then we have offices in Mayfair. We have a large operating center out in Farnborough in the UK, maintenance in Milan. So we're all over the world.
But when you're traveling, I mean, you're not selling the product. So
I'm always selling the product.
what does that mean, though? I mean, it's the Jet Card. You guys are
Yeah.
known for the Jet Card.
Yeah.
Which is a unique offering in a space.
Right.
And you're the same parent company as FlexJet, which also offers a different type of product.
Absolutely, yeah.
But how do you explain how the business model sort of complements that?
Yeah, so there's two differences, right? FlexJet is probably the premier private aviation company on the globe, and it's got a fleet of 300 aircraft and some of the newest aircraft. Sentient has just surpassed its 25th anniversary, invented the Jet Card, and it's an asset-light model. So it leverages pre-screened operators around the globe for usage of their aircraft. So we have technology that harnesses and schedules aircraft all over the world, and it allows for a different type of way to fly an entry point.
Are you ever paying FlexJet to operate for your customers?
There are some non-core fleet aircraft that occasionally we do leverage, but most of the time we're using more of a Part 135 operator in the United States or in Europe.
So this would be like a small fleet based somewhere in
It could
the
be,
world
yeah, exactly.
that has passed your
certification
certifications.
standards, correct.
And you're essentially paying them to then take your customers
Correct.
somewhere.
We handle, and so it's interesting when you mention commercial, private aviation's all about that consumer promise and that service level. So it's kind of like curb to tail. And so, yes, you might be able to replicate in-cabin experiences, but outside the cabin, getting through like a commercial hub or something like that is very different than, pulling right up to a tail and getting on a private aircraft. You really can't emulate that experience. And so it is interesting in that regard. But yeah, we're selling sort of time manipulation at the end of the day, right? A Jet Card allows you to, everybody runs off the same watch, but it allows you privately to manipulate the time.
What's the most difficult part of your business right now?
I think the
dealing
most
with it.
difficult part of our business is we set a really high bar for our consumer standard. So it's the service level. It's the, getting everything right, having all the levers in the row, right? And making sure you need technology, you need the people. And truth be told, you really need the experience. We have a deep bench of experience, some people that have been here since the beginning
Right.
with the model. So I think that the consumer, especially because it's gotten more popular, has also a very high expectation, especially because of the price point. So you've got to deliver. And if we don't actually own that asset, we've got to make sure that we're delivering on that service level and tying that asset to the consumer promise.
Safety in this environment, because over the last few months, there have been a spate of these high-profile air travel incidents in North America. They've got the public concerned, some happening with commercial airlines, but several happening with private airlines, including a real tragedy in Arizona, and then this close near miss in in Chicago with Southwest and a flex jet. How do you look at incidents like that, and how do you make sure that the product you provide is safe?
So I know our product is safe. We invest millions of dollars in safety. We have a chief safety officer, independent safety advisory board. We have an SMS, that's a safety management system for those that don't know what that is, that's very advanced with the FAA. And so at the end of the day, a lot of times, and the report is just kind of being worked through in that particular regard, in that incident.
Yeah, the NTSB report came out last week.
It's all about
preliminary
like
report.
A lot of factors, right? So there's the factors we can control, and then there's the factors around you. So in that case, you're going to find that it's likely that there's some airport things that are happening. There's some glaring and some things like that. It's not as obvious as one thinks, but I will tell you that we have an incredible safety record, and we invest heavily in it. And I've always been impressed with what we do and how we respond and how we react to things. And we open our doors up to anybody in that regard. I will tell you that everybody talks a good game about safety in aviation, but you really have to put your money where your mouth is. It is a big investment, it's a big expense, and it's not something you would ever shortcut.
Andrew, how do you make sense of kind of the environment we are? You know, we use words like potentially recession and volatility and uncertainty and, you know, the kind of world breaking apart in new pieces.
Right.
How would you describe it from what you see, especially as you travel around the world and have global customers?
So it's interesting. In the States, I see still the robust demand. Like I said, that we're seeing the growth. When we see a slowdown, and we've seen pockets of it over the years for moments and pauses, like the beginning of COVID and things like that, you tend to see a shift in your customer base. So you might lose some volume, but you generally tend to have pretty decent flying throughout. We saw it in the financial crisis. We actually maintained a whole different segment that flew. So there's a resiliency to it. Additionally, our customer base tends to get impacted, but impacted different than, say, somebody on, you know, your typical main street. So I think we're seeing, you know, enough flying. In Europe, I see a little softness, to be honest with you.
Interesting.
And, you know, we're doing a lot of investing and a lot of building over there. So we're almost counter in some of the regards. Other people are kind of looking at it differently. We're plowing ahead with investments and an investment strategy over there.
20 seconds. Why Europe?
Why Europe?
Yeah.
Because outside of the United States, the European Union is the second biggest private aviation market.
Sorry, I cut you off.
Remind us how much the jet card is per hour.
Average jet card is about $250,000 for 25 hours.
Okay.
And it can be a little lower on a light jet. It can be significantly higher on a large cabin.
So 10,000 an hour?
Give or take, yeah.
Give or take. Cool stuff. Andrew Collins, President and Chief Executive Officer of Sentient Jet, joining us right here in studio. You are listening and watching Bloomberg Businessweek Daily.